Howdy, Jacob here. Today we're looking at Axcelis Technologies. We see that they are a $4.3 billion market cap business on $3.8 billion enterprise value in the semiconductor and semiconductor equipment industry. Looks like they design, manufacture, and service ion implementation and other processing equipment used in the fabrication of semiconductor chips all around the world. We see that most recently their return on invested capital has been very substantial. Outside of the most recent 2 years, though, it's pretty volatile. The semiconductor business is pretty volatile on demand of companies, so no surprise there. We see that over the last 10 years, there were 3 times where revenue actually went down 3%, 11%, 22%, but it's definitely increased more over the long term with over 196 million in 2013 to 920 million in 2022. So quite a bit of growth on an average basis. The balance sheet, I'm sure, looks good. Yep, zero short-term debt, zero long-term debt, and about 430 million cash on hand, cash-like equivalent products. And actually, they have over $400 million in like cash, very liquid assets, and 346 in total debt. So from a balance sheet perspective, beautiful, wonderful, gotta love that. From the cash flow perspective, we see that the use of cash has recently been reinvesting, so that's great. When they have such a great return on invested capital, most recently, it looks good that they're reinvesting that. And then outside of that, really just share repurchases. And I mean, again, the things you could do with capital: make acquisitions, reinvest, buy back shares, pay down debt, and pay a dividend. And we see that no dividend here, which again, when we look at these types of businesses with return on invested capital greater than 15%, we only want to see them pay a dividend if, one, the payout's extremely low, just so they can, some companies just like to say that they have a dividend that is fairly consistent. But two, if they just don't have the capital to allocate anywhere else to get, 8 to 10% return, you might as well just give it to the shareholders that have invested with you. But odds are, in this case, especially with return on invested capital greater than 15%, these companies can find places to reinvest their capital at greater returns than just giving dividends to their shareholders. And so you'd want them to do that. That's the best allocation of cash for the company. And we see that, reinvesting and buying back shares, probably the two most important things that they could be doing at this point, since they have no debt. And so really, you just want to make sure that they're buying back shares that are stupid cheap and reinvesting when they have possibilities of great returns. And I mean, great news on the margin side: 34% gross margin to 44%, and then negative operating margin to 23%. So really, I wonder whether this incredible margin compared to history will stick. I think I'll probably lean towards a little bit more in the conservative end because that's just what I do. But I would say that their growth rate's pretty volatile. I probably wouldn't be surprised if they grew at maybe 8%. Maybe after this period, maybe we'll see 17 P price free cash flow. It's more just perspective here. I'm saying that they'll probably have more growth in the market, but their return on invested capital has only been great for 2 years. And so really on a 5-year average basis, we're probably looking at low double digits, maybe in that like 10 to 15% range, which is still well above weighted average cost of capital, and I'm sure, and then well above the market, but also 17 is above the market. And so that's just me being conservative and also just not knowing exactly what's going to pan out. Usually you want to put in your best estimate and then change the discount rate, but I usually like to put in conservative estimates that I think are still very likely and then still get a 15% return. So I'm going to say 15%, 13%, share change. They have been buying back shares recently, and that gets us to what we got here. Okay, 57%. It would need a fall before you get a 15% return, given these assumptions. I mean, again, just a fantastic company. I assume that a lot of these companies that have great returns are going to look like great companies, but again, every investment is the present value of all future cash flows. And so whether I'm buying a business that's not growing or one that's growing double digits, it really just depends on what I buy it for. Like if I'm buying something that is going to increase, 100% this year, 90% next year, 80% next year, but I'm buying it for 10,000 times earnings, or I'm buying a business that's going to be flat for 10 years at 2 times earnings, the better investment is likely going to be the one that's 2 times earnings being flat, all else equal. And so you just have to take that into consideration. My time frame is going to be different than your time frame. I usually like to just do 7-year periods because that's what I've reviewed over a 100+ year period as being the cyclical periods. So saying that, sometimes it might be less than 7, sometimes like recently from like 2009 till 2020, if we can even call the COVID crash a crash, then that was obviously 11 years or 12 years. So the periods are different, the durations are different, but for me, I like to use history to, put my best estimate and then just be conservative from there. So I feel like for now, I'm just waiting on this company to drop a bit more before I do more research on it. But again, it's a fantastic company. Hopefully everyone enjoyed the video. Thanks.